At the end of Q2, we'll see triple-digit silver again. It could be 101 or it could be 200. But all indications are nothing's changed other than over-leverage. That's been wiped out in a day. Usually these type of what I call waterfall declines take about 3 days at a minimum just to clear the books. Have we hit a bottom and we're going to bounce back up? Or we're going to have to build a new base along the $80 level for silver and $4,500, $700 range for gold. We don't know yet.
There were scenarios where a short squeeze could have resulted in $500 silver, as one of my previous guests said could even happen.
When you go straight up like that, you lose momentum. And then the people that are on the other side, which is usually the bullion banks, the commercials, see an opportunity and they sell into it to increase the momentum. Margin requirements go up the next day and away you go. Is there still a price difference between Shanghai and the London, New York market? And the spreads exist due to capital controls, import rules, taxes, financings, the form of delivery, but the arbitrage is still there. Physical needs in Shanghai at this time still exist.
What do you think happens next year? Do they sort of come back into play? Is this a short-term pullback? What's your read on what the next move in the silver market could be?
Well, first of all, I think what it does re-emphasize, first and foremost, it matters the most to the public because the public will learn again to distrust paper claims on gold and silver, even inside China. And I know we could, if we have time, talk about what's going on there with some shenanigans with not being able to deliver. We'll address that later. But that's number one. You know, if you don't own it, you don't touch it, don't hold it, you don't own it. So I think that's been re-emphasized. The second thing is none of the fundamentals change as you outlined so eloquently. Lastly, it's an opportunity for people that are late to the party. I mean, there's people that watch silver go from the $50 breakout all the way to like 120, not, last week, and saying, oh, I missed it. Now they're seeing it below 80. It's off, 5.5% right now, as I look at the last one I have on the chart here, and it's $80. So 80 to 140, that's a big percentage move just to get back to where it was, a few days ago. And I think it will do that.
The calm truth here is that price volatility is doing the market's dirty work, not signaling failure. David Morgan frames this pullback as a trust reset, not a demand collapse, and that distinction matters. A drop from 120 to below 80 feels dramatic, but a 5 to 6% swing is normal in a thin market like silver, especially after a parabolic run. Historically, silver corrections of this size during strong cycles have often preceded higher highs within months, not years. The real message is about ownership risk, paper exposure versus physical control, which becomes clearer during stress. This isn't about chasing missed upside. It's about understanding structure. And next, David Morgan explains why that structure still favors patient holders over emotional traders.
I don't think this is over by a long shot. In fact, I'd almost say I know, but I don't want to get in trouble with the authorities. But all indications are nothing's changed other than over leverage. That's been wiped out in a day. It'll probably take a couple more days, Michelle. Usually these type of what I call waterfall declines take about 3 days at a minimum just to clear the books. I mean, there's people that say, yeah, I'll wire the money, I'll cover my margin, and guess what? It doesn't come in time. Then what happens? Well, they sell them out. So there's a lot going on kind of behind the scenes that needs a few more days in order to clear the market. Once that takes place, we'll get a better feel for have we hit a bottom and we're going to bounce back up, or we're going to have to build a new base along the $80 level for silver and $4,500, $700 range for gold. We don't know yet.
Again, we'll get to gold, but just to wrap up on silver, I mean, we had obviously triple-digit silver, that major psychological milestone hit, and that prompted some people saying we could even see $200 silver this year. Some forecasts were very, very dramatic, saying as much as $250 silver this year. There were scenarios where a short squeeze could have resulted in $500 silver, as one of my previous guests said could even happen. Does this change your forecast?
This is where hype quietly dies and mechanics take over. David Morgan is pointing directly at leverage failure, not a broken thesis, and that's a distinction Wall Street rarely highlights. Waterfall declines are margin events, not value judgments, and historically they take days to clear because capital moves slower than panic. The $200 to $500 silver forecasts weren't wrong mathematically, but they ignored how fragile leverage positioning becomes after triple-digit headlines. That's why forced selling creates artificial lows before real buyers step back in. Investors should note this isn't a bottom call. It's a cleanup phase. And what David Morgan says next reframes why patience, not prediction, determines who actually survives these flushes.
I know you said you're waiting for some more information to come out, but if you had to take a position, where would you see silver, I guess, at the beginning of at the end of Q2? Let's go with that. Let's go with that line.
All right, end of Q2. I think we're so strong that at the end of Q2, we'll see triple-digit silver again. I'll leave it there because that leaves it real safe. It could be 101 or it could be 201.
All right. I know I like to put people on the spot, and I always appreciate it when they do actually take a position. But look, as you were saying, we don't really see moves like this in gold. Silver is a thin market. It's a tiny market. I believe the annual supply, depending on his data you go by, 98 billion at current prices compared with 787 billion for gold, right? So the speed and scale of this kind of movement in silver, breathtaking, but for gold, that was quite unusual because this is a very large and liquid market. So what happened with gold?
Same thing, really. I mean, not to the details I gave you about silver with the AGQ, but over-leveraged. It's normal activity.
Here's the part long-term investors should slow down and listen to. David Morgan deliberately avoids a precise number because the range matters more than the headline. Silver's entire annual market value is roughly 1/8 the size of gold's, which explains why price swings look violent but aren't abnormal. Thin markets overshoot in both directions, and leverage magnifies the illusion of instability. Gold's parallel move confirms this wasn't a silver-specific failure, just a liquidity event across metals. For portfolios, this reinforces why position sizing matters more than timing calls. Chasing targets misses the real signal. And next, David Morgan connects this volatility to why corrections are often the healthiest phase of a bull market.
When you go straight up like that, you lose momentum. And then the people that are on the other side, which is usually the bullion banks, the commercials, see an opportunity and they sell into it to increase the momentum. Margin requirements go up the next day and away you go. And so it's kind of a shortened version of what I said about silver, but it does take place. And really in a way, and people may get upset with me emotionally, but I think in the longer term they won't. It's actually healthy to get a correction here. And remember, the function of a major bull market that we're in is to shake off as many people as possible all the way up. I mean, there aren't too many bull riders that go the full 8 seconds. And, that's a metaphor for holding on to that bull to the very end. And there'll be a lot of people that got in at $50 silver, and maybe they got out at 100 and they were on leverage, and they'll never touch silver again because they wanted the paper profit and they know how volatile this market is, and they accomplished something in a matter of weeks that silver holders that have held for 25 years haven't accomplished. So as far as, profit or paper profit. So it's a very interesting market. I won't belabor it any further, Michelle. It's normal. It's okay. It's okay with me. And the longer term, it's healthier because it allows the market to shake out what we call weak hands. The strong holders are still holding, and now new people that are willing to, let's say, mitigate the risk in the overall financial system are able to come into this market.
This is the uncomfortable truth most investors only learn the hard way. David Morgan describes how bull markets actively remove participants through volatility, not reward everyone equally. Bullion banks and commercials don't create momentum. They exploit it once emotion replaces discipline. Historically, the strongest advances occur after weak hands exit, not before, which is why corrections often feel personal but serve a structural purpose. Short-term winners confuse speed with skill, while long-term holders survive because they size risk correctly. This isn't chaos, it's market design. And what David Morgan implies next is why the final phase of a bull market is usually owned by the calm, not the clever.
Fundamentals obviously haven't changed here. The same fundamentals that have been driving this tremendous silver rally. And one of the big factors there, as we have been discussing, is this dramatic increase of industrial demand for silver. And we'd also been seeing a dramatic increase in the taking of a physical delivery. So what are we seeing now? Are we seeing a big premium between the physical market and the paper market? Or are we seeing a big premium or a spread rather with the markets in the East compared to the markets in the West? Because we have been talking about the Shanghai premium. What are the numbers telling us there?
That's great. Let's separate this. Is there still a price difference between Shanghai and the London, New York market? And the answer is yes. And let's separate the signal from the noise. Gold, according to Reuters, Reuters reported China's trading at a premium versus a global benchmark up to $32 per ounce in gold. That was about $8 differential the prior week. So going into the break, actually the spread widened. So that's according to Reuters. So I'm citing my source. Silver, you'll see lots of claims about massive, persistent spreads. Some of these are methodology games, looking at different products, taxes, VAT, conversions, different delivery terms, all kinds of stuff gets in the mix. It's never really talked about, but they'll show you a picture from eBay and claim, that's the differential. So treat a lot of that as noise.
The real story here isn't the headline spread numbers, it's how easily bad data gets laundered into market narratives. As David Morgan has warned repeatedly, premium claims without standardized methodology distort investor perception, especially when Reuters data shows China's gold premium widening from roughly $8 to $32 per ounce in a single week. That divergence signals regional stress, not a simple price arbitrage, and it matters for anyone assuming paper prices reflect physical reality. When social media screenshots replace audited benchmarks, investors lose context and volatility looks irrational instead of structural. The danger is mistaking noise for signal and exiting positions just as physical demand tightens. Next, David Morgan highlights why this gap matters more for silver than most traders realize.
But the actual verified is, yes, there's still a spread in silver between Shanghai and New York. And the last I looked, it had been widened from what it had been previously. So the bottom line is the spreads exist due to capital controls, import rules, taxes, financings, the form of delivery, but the arbitrage is still there. It's obvious. And it does point to the fact that the physical needs in Shanghai at this time still exist.
Right. And again, the big macro fundamental factors that we have been saying are converging are still very much there. Industrial demand still surging from solar, electrification, defense, semiconductors, data centers, AI. That demand is still there very much so. Nothing's happened there fundamentally, right? The physical silver supply is still tightening. We do have 4 consecutive years where the Silver Institute says that global demand has exceeded mine production and recycling. So inventories is still steadily being drawn down. There's still no more silver all of a sudden coming out of the market. Silver, as we've discussed before, being made a critical mineral, essential to national security. And then, as we have been discussing as well, the monetary side, silver seen as an asset against fiat debasement and devaluation. And so those factors are still very much at play.
What's understated here is how persistent shortages quietly compound risk for long-term holders. David Morgan has emphasized that 4 straight years of demand exceeding supply is not a temporary imbalance, but a structural drawdown, confirmed by Silver Institute data showing inventories shrinking annually. Industrial demand from solar, AI, and defense isn't cyclical hype. It's policy-driven and capital-intensive, meaning substitution is limited. Add capital controls and delivery constraints, and spreads become a symptom, not the disease. For portfolios, this argues against chasing paper volatility and instead reassessing physical exposure and sector allocation. Next, David Morgan explains why monetary demand may amplify these supply pressures faster than markets expect.
One of the biggest drivers was central bank buying of gold. And the narrative, David, from the mainstream is that one of the triggers, if not the predominant trigger for Friday's crash, was news, as you touched on, that President Trump was nominating Kevin Warsh to lead the Federal Reserve. The idea is that he's hawkish. He's not going to cut rates as aggressively, potentially restore faith in the dollar. I mean, firstly, what do you make of that general narrative?
Well, I think it's overdone. I mean, I wrote one of my subscribers, you could imagine what my life was like on Friday. And he went through what happened. And, I think I gave him like a 6-point post back to his email. And I talked about Warsh as the first thing, because that's what you're getting from the mainstream. But I said that is really, in my view, a way to perpetuate the idea that's very important, that the Fed is all powerful. I'm going to digress for a moment. I'll come right back, Michelle. But in the movie The Four Horsemen, which I'm in, is Julia Tink, who works and still does, to my knowledge, at the Financial Times. So something very interesting in that movie. And we're talking about the markets, gold and silver particularly, and, what was the important point of all of it.
This narrative leans heavily on the myth that one appointment can instantly reset global markets. David Morgan has consistently argued that attributing sharp sell-offs to a single Fed headline ignores deeper liquidity mechanics, especially when central bank gold buying has accelerated since 2021. Rate expectations don't erase leverage, margin calls, or structural imbalances, yet headlines pretend confidence can be restored overnight. For investors, this misdirection matters because it shifts blame away from systemic fragility and toward personalities. When markets worship the Fed, risk management gets outsourced instead of measured. Next, David Morgan challenges why this belief persists even after repeated policy failures.
He said the cognitive map was what's important, a fancy way of saying it's what you're taught to believe about these markets is what gives these banks the ability to have the control that they have. So I digress, I'll come back, but gold behaved exactly as it should have in a stress event. Gold corrected sharply, but it did not structurally break. Silver collapsed, but gold absorbed the stress. Gold is sold off, it's highly liquid, highly traded via futures and ETFs, and routinely becomes a source of cash when margins rise elsewhere. So that's what I'll call normal activity on a very stressful day. This was a leveraged flush, not a repudiation of gold. Gold's drop was driven by forced selling from futures, as we said, margin hikes, and fund selling what they could if they needed money from margin calls and other areas. There's no evidence of central banks selling. I think that's important.
Well, no, I mean, and we've seen that trend, as we say, accelerate throughout since about 2021, where we've seen central banks just continuing to bolster their positions with gold holdings. What I find curious, though, is that people are seemingly very open to accept this idea that Kevin Warsh is going to come and all of a sudden be hawkish, when we have President Trump explicitly saying that he wants lower rates, right?
The sell-off looks dramatic only if you ignore how stress actually propagates through markets. David Morgan has pointed out that in every major liquidity event, gold gets sold not because it failed, but because it works as instant collateral, especially through futures and ETFs. The absence of central bank selling since 2021 undercuts the hawkish narrative entirely, while leverage unwinds explain the price action cleanly. Investors should read this as confirmation of gold's role, not its rejection, and question why policy messaging contradicts political pressure for lower rates. Next, David Morgan connects this behavior to why silver volatility keeps confusing traders.
So now he goes and nominates someone, and all of a sudden people forget that for the longest time the president has been, we can say, attacking Jerome Powell for not cutting rates. Is it to believe that he's going to nominate someone And again, I'm not trying to make necessarily conjecture about Fed independence, but it's very unlikely that the guy that Trump picks is going to be the one guy that is going to go completely against what he's been saying he wants all this time, right?
Very,
So, I'm sorry.
I didn't mean to interrupt. Very perceptive, Michelle. I mean, to me, as the Eleanor Roosevelt said, very little happens in politics by accident or mistake. I think it was a brilliant move on the part of the administration. And believe me, I do not like the political class generally. However, it's a very good way to do a trial balloon. What if we were to raise interest rates? What would the markets do? Well, we just saw, that's their main excuse. Again, I think it's a lot of other things we've already discussed, but that's the one that's the flagship that the mainstream financial press keeps touting. And it was a good way to send up a trial balloon and say, how vulnerable are the precious metals markets? Let's see what happens if we talk the talk, maybe not walk the walk. And we saw what happened.
This wasn't a policy shift. It was a messaging stress test disguised as leadership news. As David Morgan points out, markets often react more to perceived intent than actual policy. And this episode fits that pattern perfectly. The idea that a president who publicly pressured the Fed for rate cuts would suddenly install a hardliner strains basic political logic. Instead, this looks like a trial balloon to gauge how fragile precious metals positioning really was after a crowded rally. Investors should note how quickly sentiment flipped on words alone, revealing leverage sensitivity rather than fundamental weakness. Next, he explains why this reaction tells us more about media framing than monetary reality.
Is that the main factor? To me, it wasn't. But to many people that just read the Wall Street Journal, it was the main factor.
Right. And it's interesting to think that there's an expectation that all of the Trump rhetoric would kind of go away just because he nominates this guy who traditionally or has recently been saying he'd take a more hawkish position. Of course, we still need to get this guy confirmed. So there's still a long way to go before Kevin Warsh is actually able to enact any rate increases or rate cuts or any kind of policy position. I will point out, though, that just today, even with what we saw with gold, JP Morgan came out saying that they do see gold prices hitting 6,300 by the end of 2026. This is today. And Deutsche Bank on Monday reiterating that its gold price forecast is 6,000 an ounce in 2026, citing the same fundamentals that we have discussed: investor demand, despite an adjustment in prices, the debasement trade, central bank purchasing. So it doesn't, again, seem as though any of the fundamentals have changed. On the contrary, we continue to see central banks, which have been a big driver of this, continue to bolster their positions. What is your outlook on gold then?
Headlines scream fear, but institutional forecasts quietly stayed bullish. As David Morgan notes, when banks like JP Morgan project $6,300 gold by 2026 and Deutsche Bank reiterates $6,000 targets, it signals conviction beneath surface volatility. Confirmation timelines, Fed politics, and rhetoric don't erase structural drivers like central bank accumulation and currency debasement trades. The disconnect here is striking. Retail sentiment whipsaws, while institutional models barely flinch. For investors, that gap matters because long-term capital follows fundamentals, not daily narratives. Next, he outlines why this divergence often precedes consolidation, not collapse.
Physical gold remains tight. It's quietly the same place it was without all this futures movement. The Asian demand didn't vanish. Premiums compressed a bit, but they didn't invert. There was no flood of distressed physical supply sales. You did see that somewhat in the silver market. The market talked panic, but it really didn't realize it. The market confirmed it's strong. This is where watching the flows probably are more important. As I said, central banks were selling. And I think the key here, we haven't discussed, but critical to gold, silver, but gold particularly, is gold versus the dollar. This is a key. And the dollar bounced hard and gold corrected. That's normal. What matters next is if the dollar holds firm and gold stabilizes. that's a bullish divergence. And we may see, as I said earlier, that we'll get a new back and fill, as it said in the commodity parlance, of where we get some kind of a trading range for both gold and silver. And that, again, would be healthy. It would actually stall out people that expect this rocket ship move to start a day after tomorrow, and it doesn't. It starts to level off in the trading range, and they get bored.
This is where discipline matters more than prediction. As David Morgan has emphasized, tight physical markets alongside futures volatility usually reflect liquidity stress, not demand destruction. A dollar bounce causing a gold pullback is textbook behavior, but the real signal is stabilization, which often precedes renewed upside. Trading ranges frustrate momentum chasers, yet they reset risk and shake out weak hands. For patient investors, boredom is often the price of durability. Next, he explains why these pauses can be more bullish than sudden spikes.
Silver's gone from, I don't know, make up two numbers, from 75 to 85 for 3 months. Oh, it's not doing anything. No, I'm getting out. And then, of course, the market starts off again. But I think it's going to come up rather quickly, because we are in the final phase of a currency distraction. And because of that, there's more and more impetus by people that don't even know how to spell gold right now, thinking about it and taking action upon it in 2 or 3 months from now, as an idea.
The real risk isn't silver going nowhere. It's investors misunderstanding consolidation. As David Morgan observes, sideways price action often masks accumulation phases, especially late in currency cycles. History shows that retail exits boredom trades just before momentum returns, a pattern repeated across commodities and equities alike. The final phase language may sound dramatic, but rising first-time buyer interest is measurable during late-stage debasement periods. Investors who mistake calm for failure often miss the sharpest repricing.